Hello, everyone. This is Lisa Ruggiero. I'm a program coordinator at the Syracuse University Environmental Finance Center. On behalf of the Environmental Finance Center Network, I'd like to welcome you to our webinar entitled Key Financial Indicators. Here with me today, I have two of my lovely EFCN colleagues. First, I'd like to introduce Miss Lexi Kay. She's here to help me out with some technical support today.
Hi, everyone.
Hi, Lexi. And of course, our financial indicator guru, Mr. Glenn Barnes.
Hello, everybody. Thanks for joining us today.
Excellent. So you guys are both coming in loud and clear over the audio, and I will let you take it away, Glenn.
Okay, thank you. And thank you, everybody, for joining us today for our very exciting webinar to talk about key financial indicators for your water system. I'd just like to show a map of who has registered today. As Lisa mentioned, we have more than 300 registrants for our webinar today all across the United States, every time zone from Atlantic to Hawaii. We also have a number of people joining us from Canada, and I'd like to give a special welcome to our guests joining us from East London, South Africa. Just on a personal note, I lived in South Africa for a long time, and I'm country is very near and dear to my heart. So welcome to all of you today for joining us. Before we get started, I'd just like to do a couple of quick polling questions so we know who is on the line today. And Lisa, if you would be so kind, can you pull up our first question, please?
Absolutely. Here's the first question.
All right, and so our question here is, what kind of drinking water utility do you represent? And so please choose the option that is most relevant to your water system off of that list, and we'll show the results in just a second here.
Great. People are still clicking in their votes, Glenn, so I'm going to just give them a couple more seconds. All right. At this time, I will close the poll, and here are the results.
Okay, so we've got a good mix of systems here, quite a number from local governments, as well as some not-for-profits, other utilities, and some for-profits. And thank you to everybody joining us, not a drinking water utility, who probably work in state and federal government and help support water systems. So thank you so much. Lisa, let's pull up the second polling question, please.
All right.
All right, so this is especially for those of you who are from water systems, what size drinking water system does your utility operate? By number of people served, please. And if you're not from a drinking water system, as you just indicated on the last slide, there is that last button for you to select.
Excellent. We're still getting people clicking in their votes, so I will wait a few more seconds before closing the poll. Okay, and here are the results.
Okay, so good mix across the board from very small to small, medium, and some large systems as well, and we welcome all of you to today's webinar. And really, for all of you, the subject matter that we'll be talking about today, measuring key financial indicators, is going to be relevant whether you're a very small system or a large system, whether you're run by a governmental entity or by a for-profit or nonprofit business. Understanding where your system sits financially and how to improve that is going to be a real key for all of you in terms of good, smart financial management. So, Lisa, if you could go ahead and close the poll out for now, we'll get back to the polling questions a little bit later.
Okay.
So as we start, just a quick word about the project that we're working on today. So this webinar is made possible through our Smart Management for Small Water Systems project, funded by the U.S. EPA. And for this project, we're doing work in every state and territory in the United States on finance and management issues related to water systems. And as I mentioned, for those of you who are joining us from larger systems, by EPA definition, that's serving 10,000 or more people, you're going to find today's webinar equally useful, and we're very glad to welcome you today to the webinar. My objectives for our hour together today is to help you understand the tools that you need to know where your water system is right now financially, and to learn some standard measures that funders will be concerned with. And so my hope is that by the end of the hour, I'll show you how to calculate some basic financial indicators for your water system, give you an opportunity to do that on your own with your own set of financials. Or if you're interested, we have technical assistance available, paid for under the grant, so at no cost to your water system other than your time. And we can help you with these calculations and help you interpret them and explain to you what they mean and maybe what steps you need to improve them if necessary. So when I think about key financial indicators, a lot of it comes down to just this question of, financially speaking, can you sleep at night for your water system? And the types of questions that might keep you up at night, like, is your system self-sufficient? Are you able to cover your debt service payments after paying for your day-to-day operations? If your customers stop paying their bills, how long can you maintain operations? Can you meet your short-term obligations? And how much of your system's expected life has already run out and how much is left? And interestingly, all of these questions have a financial ratio associated with them. And we're going to go through each of these ratios today and demonstrate to you how you can actually calculate them based on financial statements. But before we get into that, I would like to get a sense of where everybody is right now in terms of their system finances and how well you can sleep at night with your system finances. So Lisa's going to pull up a polling question for us here. So in terms of your system's finances, how do you sleep at night? And let me explain a little bit about the answers here. So I've always had like a baby as the first option, but I had a workshop participant say, well, I have a newborn and she wakes up screaming every 2 hours. Is that what you mean? So we've edited that to include sleeping like a cat, some tossing and turning, insomniac, heavily medicated was also suggested by a workshop participant. And if you're not sure yet, and you might have a better sense by the end of the webinar, you can pick the last option. So please go ahead and choose one of the answers here for us.
Awesome. People are clicking in their votes, so I'm going to give them just a few more seconds to choose the answer that best fits them. Okay. And at this time, I will close the poll and share the results.
All right, so some of you are sleeping pretty well. That's good. That's what we like to hear. Number of you are doing some tossing and turning, and then there's 11% of you insomniac or heavily medicated that I hope today's session will help point you in the right direction. So thanks so much for answering that. And we always try to work a little bit of humor into environmental finance and otherwise somewhat dry topic. And the beauty of a webinar is, since I can't hear any of you, I'll assume that all of you laughed when I told my joke. So onward we go. I can hear Lisa laughing at least. So we have prepared at our Environmental Finance Center in North Carolina a really helpful whiteboard video about financial benchmarking and about key financial indicators. And when we share with you the slide deck after today's webinar, you'll get a link to this particular video that you can rewatch or ask your colleagues to watch if they weren't able to join us today. And it's about 10 minutes long, and we'll really explain everything that we want to go through on today's session. Now, we had thought about showing the video as part of the webinar today, and as wonderful as webinar technology is, one thing that our experience has taught us is that when you have 300 attendees, video tends to not work so well. It tends to be a little bit choppy and the audio is a little bit disjointed. And so to save you from that, what I'm going to do is actually show you some screenshots of the whiteboard video and talk through some of the key points that we go through. But I really do encourage you to share this link with your colleagues in your water systems, because I think it will be a very helpful way for them to begin to understand how to do these key financial indicators. And so this whiteboard was put together. It's part of a series of whiteboard videos we call Water Clips, and it was funded by the Water Research Foundation and the U.S. Environmental Protection Agency. It's one of 3 that we've produced so far, and when you click on the link to that, you'll be able to see all 3 of them, and the other 2 are on financial topics as well. So the whole reason that we care about tracking financial ratios or key financial indicators is that it's a very useful management and decision-making tool for your system. It can help you measure your financial strength and stability, your creditworthiness, and your growth capabilities. And monitoring how these ratios track over time or how they compare to other utilities allows you to assess your current financial position and whether or not you need to make changes to your rates and financial policies both now and into the future. But typically when we see systems wanting to compare on financial measures, what they do is they pick 1 gallon mark of water, say 5,000 gallons, and they will compare their rates to other utilities in their area based on that 1 point of consumption. And this is how oftentimes, too often, unfortunately, utilities are looking at comparing their financials. And when you're just looking at price alone, the incentive is really just to have the lowest bar on the graph. And we see a lot of systems that brag about having that. And certainly there's nothing wrong with striving for affordable rates and to strive to be efficient. But looking at this metric by itself can provide a very narrow perspective on the overall health of the system. And, you know, we kind of think about it from the perspective of it's like comparing your wealth to your neighbor's simply by comparing cars. It's just not the whole picture. Now, of course, having low rates does not necessarily indicate that you as a system are covering the true cost of service in a cost-effective manner. Behind a small bar may be a system that's not collecting the revenue it needs to deliver high-quality water, good customer service, or to ensure the long-term future of the system or to protect the environment. Now, of course, that's also true for systems that have high rates as well. That's not necessarily guaranteed, but it's certainly something that just having a low rate doesn't tell you. So simply, you can't answer all the important questions about the finances from 1 point of comparison. How well are you recovering costs through revenues? Can you reinvest in your system's infrastructure? You have to dig deeper. And so this webinar is about that process of digging deeper. And we want you to consider a range of financial metrics to get a more complete picture of the financial stability and health of your water system. And that's something that not only should you do as a system, but your board should look at this, and I assure you your funders and creditors are looking at this as well. And a series of financial benchmarks and targets are important for providing long-term guidance for your system in creating a common framework for the system to make decisions. And because these ratios are very widely used, they enable you to compare your own system with industry-wide averages or standards. And so what we're going to cover in the webinar are these 4 main financial metrics and what they tell you. So I want to start with a ratio called current ratio, or oftentimes also called quick ratio. And this is a measure of short-term liquidity. How well are you able to pay your current bills? And the way that we calculate this is by dividing your unrestricted current assets by your current liabilities. And so because the cash and current liabilities that you have change, this is something that's important to look at on a regular basis. And I think, again, let's go back to the example of having a car, because a current ratio for somebody that has a car would be whether or not the driver has enough cash to pay current bills, to keep the car going, like a gas bill, a loan payment, insurance, a mechanic if necessary. And so it's the same for a water system. Do you have enough money in hand right now to pay off the bills that you have in hand right now? And again, when we calculate this number based on your financial statements, those statements are representing a snapshot in time. The numbers for your current assets and current liabilities reflect what they were on the day that your financial statements were prepared. So this is a measure that changes over time, but it's still a good way of getting a sense based on that day whether or not you're in a good financial position. Another indicator similar to this that we can look at is days of cash on hand. And so this is, in essence, how long can your utility continue to operate because you have money saved up that cannot be used for anything else or isn't earmarked for something else before running out of money. So what you do is you take that unrestricted cash and investments that you have and you divide it by your operating expenses, and in this case you'd exclude depreciation, divided by 365 so you get a sense of what your daily operating expense is. Now, the reason that we want to know how many days of cash on hand there are is whether or not your system could survive a downfall in revenue, whether that's because of, say, drought conditions where your customers are cutting back, or perhaps you have a very large customer like a commercial property that may go out of business and you lose that revenue coming in. How long can your system last? Now, there's no natural objective target for you as a system to aim for. Obviously, the higher the number that you have, the more protected your system will be against revenue shocks, but it's a subjective number. And generally speaking, would like you to have at least enough to exceed the length of your billing period, whether that be, say, 30 days, 60 days, 90 days, that you have enough cash on hand before the next infusion of money from your bills comes in. For some systems, if you get very high seasonal revenues, you may want to think about having enough cash on hand to last you until the next season. But to give you some sense of the number, we took a look at AAA-rated water systems as rated by Fitch, and their median days of cash on hand in 2013 were 427. So that's quite a bit. If that water system got no revenue, it can continue to operate for more than a year just based on the cash that it has on hand. Now, from the car equivalent, this is basically to say how long could our lovely driver here continue to operate his car if he were laid off and not getting paid anymore. So moving beyond measures of cash and how cash looks on a current basis, we want to take a look at some broader perspective ratios as well. And I'm going to start with operating ratio. Now, operating ratio offers this broader perspective on self-sufficiency. It's a measure of whether revenues were enough to pay for expenses over the course of a year. So unlike the days of cash on hand and current ratio, which is based on a single day, operating ratio is based on an entire year's worth of data. And as calculated here, the operating ratio is the total operating revenues divided by the total expenses, although sometimes you'll see those numbers inversed. Now, total operating revenues are primarily money coming in from the sale of water, essentially your monthly charges, from penalties, fees, connection fees, and other charges you set for services. And the operating expenses are the cost of operation and maintenance, such as operating and maintaining pump facilities, cost of chemicals, salaries, wages, billing, administration, insurance, taxes, customer service, etc. You could really stop there and calculate a ratio that would capture your system's ability to cover its day-to-day operations and general upkeep through the revenue. But in fact, this may be the ratio that our driver has calculated when deciding if he can afford a car. Do his paychecks exceed the payments needed for gas, oil changes, unexpected maintenance, and the general upkeep? But a more complete ratio is going to also include depreciation with total operating expenses. So depreciation is determined by accountants, and it's the value of an asset spread over the life of the asset. And while this is not a perfect indicator, depreciation is used to summarize the cost of replacing capital assets at their original price. Basically, in lay terms, it's the annual wear and tear on your system. You know, if you were the man in the car, you might be wise enough to factor in the cost of replacing auto parts and tires as they wear down and to set that money aside over time. Because if you set aside money to cover depreciation, then theoretically you have enough money to replace the asset to its original condition at its original price. Now, this is obviously not a perfect indicator of capital costs because costs change over time. The type of assets you need may be different in the future. But most likely the man in the car is going to have to pay more for tires and parts than he did 4 years ago, but at least there's some money being set aside. So the best way of calculating operating ratio is to divide operating revenues by your operating expenses, including depreciation. And because at least there's some measure of capital costs built into this measurement, even if they're not perfect. And that operating ratio will indicate whether or not a system is collecting enough revenue to operate its current system and maintain your current level of service. So basically, if you are at 1 when you do this ratio, you are doing exactly that, collecting exactly the amount of money you need to run your system. But realistically, we'd like to see that number higher than 1 because we want you to have money to plan for an eventuality of future capital needs, for the man in the car when his tires go out and other issues. And so we'd like to see that number typically higher than 1. And finally, of course, we don't live in a cash-only society. Just like many of us borrow money to pay for cars, most of our water systems are borrowing money to pay for infrastructure. And so this last metric that we want to look at is going to measure your system's ability to pay off your debt, as the name suggests, because what we're looking at here is called debt service coverage ratio. And it's calculated by dividing your net revenue, so that's your operating revenue minus your operating expenses, excluding depreciation, by the principal and interest payments on your debt for the year. So in other words, after you've paid off your bills, that's your operating expenses, how much operating revenue is left over to pay for your debt? And lenders typically like a little bit of extra security when it comes to this. Obviously, having a ratio of 1 is the minimum you would need to be able to pay off your debt through your operating revenue. But we often find that funders and lenders want to see a higher number, and in fact, most bond covenants or loan term agreements specify exactly what this ratio needs to be, and it's typically 1.2 or higher. So that lender wants to make sure that if you do have a revenue shortfall, you have a little bit of a cushion to still be able to pay them back. So many utilities we find exceed that target. For AAA rated Fitch systems, the median debt service coverage ratio was 2.7. So once they pay off their bills, their operating expenses, they have 270% of their debt service left over. Now that's a very high number, and many of the systems on the line, especially smaller systems, probably don't have a AAA rating. So for single A rated systems, the median debt service coverage is still 1.9. And that's a pretty high number as well. So if you were back to our man in the car, you'd be pretty happy with a 1.9 because your paychecks are paying for running and maintaining the car, paying loan payments on time, and you still have enough money to pay for a better car in the future. So these ratios that we've described, operating ratio and debt service coverage ratio, really provide the broadest perspective of financial self-sufficiency for your system. And there are a lot of other metrics that you could look at for yourself, your board, your creditor, or lender. Those could include the debt burden of your system, so debt to equity and debt per capita. That's basically like a credit score for your system. The amount of depreciation in total on your assets, so how much your infrastructure is worn out and what condition it's in, and how affordable your services are for your customers. But basically, these financial benchmarks are really helpful in giving you a sense of the overall financial picture. And just like our friend in his car who has a dashboard with several dials, we want you to think about your water system from the perspective of having several key financial indicators. For the balance of our time together today, what I'd like to do is to demonstrate to you how to actually measure these numbers. And I want to take a look at two actual small water systems that look very similar on paper, but as you'll see, will have very different financials. So the two communities that we're going to look at today are both small towns. They're community water systems. They're from the same state, Bavaria and Mayberry. And I will mention, while Bavaria and Mayberry are not the actual names of these systems, these are actual numbers from actual financial statements from actual towns from a couple of years ago. So let me tell you a little bit about these two towns. Bavaria and Mayberry, as I said, are both from the same state. They serve roughly the same number of people and service connections. It's about 1,500 for Mayberry and 1,300 for Bavaria, and then around 500 to 580 service connections. And they also have very similar demographics. The median household income in both communities is roughly $30,000 per year, and they have between 23 and 27% of their residents living below the poverty line. So generally, not only are these small systems from small towns, but they're also small towns with median household income and percent poverty rates that are slightly worse than the state and national averages. Now, if you are on the line from a governmental system, which many of you are from our earlier polling question, and you follow the generally accepted accounting principles for financial statements, you will have a copy of financials for your town that will include your enterprise fund, your water system, that follows the Government Accounting Standards Board's GASB 34 standard, which is what we're going to take a look at today. Now, if you're not from a governmental system or you're from a governmental system that does not follow the GASB 34 standards, the numbers that we're going to talk about today you should be able to find on your own operating and financial statements pretty easily. And again, if you have any trouble with that, feel free to contact us and we'll help you walk through the process. But for those of you who are used to the governmental systems, let me just give a quick walkthrough of the ones that are going to be really important for our discussion today. The first is called a statement of net assets. And this is a measure of the assets and liabilities of the water system on the day the financial statements were prepared. The second is the statement of revenues, expenses, and changes in net assets or changes in net position. And this is an annual accounting of your operating and non-operating revenue and expenses for the water system. It's where, if you're a governmental system, you'll also see transfers to and from the general fund on this statement. The third statement is a statement of cash flow, which is really just money going into and out of the water system over the course of the year. And then finally, always important to any financials are the notes to those financial statements, which are explanations where needed to the statements themselves. We have put together at our Environmental Finance Center a nice two-page exercise for you where you can plunk in the key numbers that you need from the financial indicators to be able to calculate operating ratio, debt service coverage ratio, and so on. And as we go through these examples right now, you're going to see me basically populate this exercise for our sample communities, and then you can download this exercise and do it for your own system once the webinar is over. So I'd like to go ahead and start with operating ratio. As we mentioned in the whiteboard slides, that this is one of the numbers that you can get a sense of for self-sufficiency. So our revenues covering the operating expenses fully. And as I mentioned earlier, this is a number that may or may not include depreciation. And so what I'd like to do is actually calculate it both ways for you so you can see what the ratio looks like with and without depreciation, because it'll tell an interesting story about our sample systems. All right, so we're going to start with the town of Mayberry. So I've got the statement of revenues, expenses, and changes in net assets is the form that we're going to need, and then I have our exercise. And so in particular on that statement, we want to look for the total operating revenue, which in this case is $444,231. And then we also want to look at the total operating expenses for the system, which in this case is $511,448. And so I've circled those on the screen for you. So if we are to take the exercise and plunk those two numbers in, now all we have to do is a very simple calculation to find that the operating ratio for Mayberry, including depreciation, comes out to 0.87. So obviously we said we like to see this number at 1, and it's below 1, and we'll talk in a minute about what the implication of that is.
We have a question from our audience about depreciation. How would you determine the life of a piece of equipment?
This is a very good question, and thank you for asking, because I think there's 2 points that I want to make here. One is that depreciation is calculated by accountants. If they are following generally accepted accounting principles, they have a formula that they use to depreciate an asset. That formula may or may not reflect the reality of your asset as it's currently sitting in your water system. If you are really good about upkeep. Your asset may last much longer than its depreciation schedule would suggest. But if you're from a place where conditions are kind of harsh on infrastructure, and you generally find that, say, your pipes don't last as long as what the system expected averages would be, you may actually find the depreciation is underestimating your cost. But more directly, if you're curious about calculating this number for yourself, what you can do is there are several guides that EPA has put out, of engineering guides, and also some private firms, and our partners at AWWA have put out some as well, that will show you the expected useful life of certain assets. It's an estimate. It will say, pipes would last, say, 50 years. A pump would last 15 years. And depending on the quality of the resource that you get, they may go into more detail based on the type of material that's there. But for this particular exercise, when we talk about depreciation, for those of you who have an accountant preparing your financial statements, we're really talking about the number that's based on the generally accepted accounting principles. All right, so thank you so much for that question. All right, I'd like to switch over now to Bavaria, and let's take a look at these numbers. So again, we're at the same statement of revenues, expenses, and changes in the net assets. And so as we pull up that sheet in a little bit more detail, we're going to find that the total operating revenue for Bavaria is about $709,000, and the total operating expenses are $671,000 and some change. And you may notice, based on the two sheets that we just had up here, that all of the top line items, operating revenue, operating expenses, and so on, are the same between the two systems, but the sublines can change. So there'll be a little bit of a difference as we look at the sheets for both systems today. So when we put Bavaria's numbers in, about $710,000 in operating revenue and $671,000 in operating expenses, we come up with a ratio of 1.06. So as we look at our two sample communities, we find that Bavaria has cleared that 1.0 hurdle, whereas Mayberry has not. They're at 0.87, though neither system really got up to the line that we have there for 1.2. That's not a hard benchmark, but that's a number that our EFC feels like is a good target to make sure that you've got enough revenue, not only to cover depreciation, but also other capital needs and emergencies and things like that. So including depreciation, Bavaria is a little bit better off than Mayberry, but still not quite in a great position. Now, if we take depreciation out of the picture, so again, we're going to go back to the same form that we had before for Mayberry, and once again, we're going to pull up the same total operating revenue number, the $444,000, but now we're going to pull up two numbers from the bottom, the $511,000 in total operating expenses, and then one line above it, so the circle is capturing both, the $142,000 of depreciation. And so to get to this number, we have to take the depreciation out of the total operating expenses. So instead of dividing the 444 by 511,000, we back out the 142,000 and instead divide it by about 369,000. And now we come up with a ratio of 1.2. So higher than that 1.0 mark that we're looking for. For Bavaria, again, pulling up the same sheet as before, the total operating revenue has remained unchanged. That's still $709,000. The total operating expenses are still that $671 that we saw earlier, but now their depreciation is about 2/3 of the way down their list of other operating expenses. Here it's $212,000. And so when we pull up their financial and we plug the numbers in, so we'll have that $709,000 again as the operating revenue, and now we have to subtract out the depreciation from their operating expenses, so we're left with $459,000. Their ratio is now 1.55, so well in excess of that 1.0 number that we discussed earlier. And so now when we compare these two systems' financial measures for operating ratio without depreciation, we see a very different picture than with depreciation. For Bavaria, they're at 1.55, which not only clears the 1.0 hurdle, but also our kind of tentative 1.5 number that we like to see systems shoot for. And for Mayberry, they're above that 1.0 number, still maybe a little bit less of that 1.5, but they've met at least the bare minimum and still have 20% extra money lying around to help cover the cost of capital and other expenses. Now, one of the real keys for me, and again, not knowing anything more about these two water systems than what we're seeing here, is that the numbers change pretty dramatically when you include depreciation. So for Bavaria, it goes from 1.55 to 1.06. Mayberry from 1.2 to 0.87. And so what that means is two things. Number one, both systems have very high cost of depreciation. That may be a sign that their system is aging and that they need to be concerned about investments in the system. And then certainly for Mayberry, they are not recovering enough revenue in a given year to pay off the cost of their operating expenses and to set aside the full value of depreciation. So when it comes time for them to replace their infrastructure, they may find that they do not have enough in savings to do so and may instead have to rely on the debt market. Okay. So moving on from operating ratio, the next ratio I'd like to talk about, again, is from the whiteboard video, is on debt service coverage. So what we need to do here, to refresh your memory, is to take the operating revenue and subtract out the operating expenditures and then divide that by the annual principal and interest payments on the debt. And in order to do this, we now need the statement of revenues, expenses, and changes in net assets from before, but we're also going to need the statement of cash flows to get us our debt payment. So for Mayberry, as we take a look at the operating revenue and the operating expenses minus depreciation, those are the same numbers that we calculated for the previous example. So they're shown here circled again. But now we also need to pull out the statement of cash flows and find the principal paid on capital debt and the interest paid on capital debt. For Mayberry, those actually come on two separate lines, which I'm circling here on the screen for you. $49,000 in principal payments and about $35,000 in interest payments. And so when we pull up the exercise for them, what we'll find is that the operating revenues minus the operating expenses, we're putting the same numbers in before, and now we have a new number on the bottom, $84,783, which is a total of the principal and interest on the long-term debt. And when you do this calculation, you find that the debt service coverage ratio for Mayberry is 0.89. And again, as we mentioned during the earlier segment, this is a number that we'd really like to see above 1, and we'll talk in a minute about what the implication is for Mayberry that that's not the case. Let's switch over to Bavaria. Again, same two statements as we did for Mayberry. So just as before, we're going to need the operating revenue, the depreciation, and the total operating expenses from that first financial statement. And now we're also going to need to find their debt payments. And for Bavaria, they put the debt payments, principal, and interest on a single line instead of two lines, which is $190,633, which I've circled on the screen for you. So as we plunk these numbers in now for Bavaria, we have that operating revenue and the operating expenses excluding depreciation, and then $190,000 of debt payments. We find that their debt service coverage ratio is 1.32. So again, let's take a look at these two systems together. Bavaria has exceeded that 1.0, which is really the very minimal level that we like to see for systems. But as I mentioned earlier, lenders typically want you to be at a little bit of a higher level, maybe 1.2 or higher. And so Bavaria is probably around where they need to be for their debt. Mayberry, however, is not. In fact, they're not even reaching 1.0. What this is saying is that once Mayberry has paid off all of its operating expenses, its leftover operating revenue is not enough to pay its debt service. Now, this doesn't mean that Mayberry is defaulting on their debt. What it means is probably one of two things. Either they're dipping into their water utility savings to pay off the debt, or they're dipping into the general fund of the town to pay off the debt. Switching gears from these two measures of kind of overall self-sufficiency of the system, I do want to focus in on those two measures we mentioned earlier that take a look at the amount of liquidity that a system has on the day that the financial statements were prepared. So we're going to start with the days of cash on hand, where we're looking at unrestricted cash divided by the daily expense of running the system, not including depreciation. So for Mayberry, once again, we're going to need the statement of revenue, expenses, and changes in net assets. And now we're going to need a new statement we haven't looked at before, which is the statement of net assets. And so on the statement of net assets, we're looking for the unrestricted cash line, which for here, as I'm circling on the screen, is $107,706. Now you may notice, depending on how good the resolution on your monitor is, that where it says current assets, it says cash and restricted cash. If it doesn't say restricted, generally on financial statements, we assume it's unrestricted cash, although sometimes you will see it specifically say unrestricted cash. Then the total operating expenses and depreciation are the same from our last two calculations, so $511,000 in operating expenses and $142,000 in depreciation. And so when we add these values to the exercise sheet that we have, the $107,000 of unrestricted cash and then $368,000 of operating expenses divided by 365 days, we find that Mayberry would be able to operate for about 107 days if it did not receive any additional revenue. For Bavaria, again, we're going to look at the same two statements, the statement of revenues, expenses, and changes in fund net assets, and then the statement of net assets. And for them, when we look at their unrestricted cash, it's listed here under current assets, and it says cash-operating. And it's $568,061. So that's the number that we're going to need to calculate the days of cash on hand for Bavaria. And then again, we've already looked at the total operating expenses of about $671,000 and the depreciation of $212,000 previously. So when we plunk those numbers into our handy exercise sheet, as I'm doing on the screen now, we put the $568,000 of unrestricted cash in the top, and then $459,000 of operating expenses, excluding depreciation, divided by 365. We come up with a rather robust number of 452. So again, to compare the days of cash on hand for Bavaria and Mayberry, Bavaria is at a level that is actually exceeding Fitch-rated AAA water systems. So in the earlier slides, which were based on 2013 numbers, I think we said this number was 427. Based on actually the 2014 numbers that just came out a couple days ago, it's a little bit lower. It's 418. The 285 is representing single A rated communities. So Bavaria has enough cash on hand that if nobody paid their bills for almost a year and a half, it would be able to operate. Now, Mayberry is not anywhere near those numbers, but 107 days is not too shabby either. If you think about it, it's more than 3 months. And so if Mayberry were to have monthly billing, they would have enough revenue to cover themselves for 3 months of their customers not paying any bills. And so the final ratio that we're going to calculate for our example systems is that current ratio that I mentioned earlier, which is looking a little bit more broadly at cash on hand, so it's the unrestricted cash and then also receivables, divided by the current liabilities. And again, this is a snapshot based on the day that the financial statements were prepared. And in this case, we only need a single sheet from the financials, the statement of net assets. So for Mayberry, we've already taken a look at that unrestricted cash. That's the $107,000 number that we got earlier. We're now going to also pull in their net receivables, which is $41,870. And then we're going to take a look at their total current liabilities towards the bottom of the screen, which is about $108,000. And so when we take these numbers and put them together, so we add the $107,000 and the $41,000 together and then divide it by the $108,000, we come up with a current ratio for Mayberry of 1.38. So certainly they're above 1, which means that right now they have more cash on hand or did at the time the financial statements were made than they had bills, which is obviously a good position to be in. Let's take a look at Bavaria. So again, we're looking at the statement of net assets, the same form, and we've already taken a look at their cash on hand, which is $568,000. And then their accounts receivable is just the line below it, the $66,346. And then their current liabilities is $898,000. So when we put these numbers into our exercise, 568 plus 66,000 divided by 898, we come up with a current ratio of 0.71. And so now as we compare these two systems together, I had to stop and ask myself what's going on. Because Bavaria, who has a very strong operating ratio with and without depreciation, who has a great debt service coverage ratio, who has 450 days of cash on hand, suddenly doesn't look very good. And Mayberry, who's been kind of our problem child system all along this presentation, is looking very strong. And so Mayberry has achieved the 1.0 rate. Neither have achieved anywhere near the 2.0 rate that I think a lot of systems would like to have, which is to have twice as much cash on hand as bills. But it's important to remember why we need to look at the notes for financial statements and why we need to remember that this particular statement is based on a single day. Because as you dug through the notes for Bavaria, you may have found something very curious, as we did, which I'm circling here at the bottom of the screen. It says deferred revenue in the proprietary fund financial statements. Subsidy, $460,000. So essentially, what happened here is that Bavaria had applied for funding from its state, and it received $460,000 of funding to work on its sewer plant. At the time the financial statements were prepared, it had done the work, it had an invoice sitting on its desk for $460,000, but it had not gotten the $460,000 reimbursement from the state, which is how this particular state subsidies work. So instead of getting the money up front, they get it on a reimbursement basis. So in other words, this $460,000 was an anomaly. If the financial statements had been developed maybe 2 or 3 days later, that $460,000 would have come from the state and their number would have looked very different. In fact, if we recalculated, it would have looked at about 1.2. So their current ratio, again, is higher than 1. And what this means is that Bavaria, with their corrected for the missing grant funds, would be able to pay off all of its current liabilities and then have a little bit of a cushion as well. So that is a way of walking you through some examples of these financial ratios, but I want to leave you with a couple of thoughts. And one is, why do we care about this? And I think the answer really is that funders and rating agencies care a great deal about this. Over the past several months of our project, we've been holding in-person workshops on rate setting and fiscal planning. And if you attend one of these workshops, you will actually see today's presentation in person. And we also at these workshops have funders come to talk about their programs and to talk about what they look for from systems. And whether those funders are from the SRF program or USDA or perhaps from rural water or RCAP lending programs, all of them say the same thing. We want to be ensured if we lend you money that we're going to get paid back, and we look at these types of financial indicators. So I think that's a big reason why we need to be concerned about these as systems. And then secondly, as you think about the future needs of your system for capital planning, for asset management, for where you need to take your infrastructure in the next 5 to 20 years, it's really important to know where you're starting from. If you need to raise your rates to cover the cost of capital, you may also need to raise them to cover the cost of your regular operations, which it may not be covering currently. Now, I mentioned earlier in the video that it is possible to also look at asset depreciation overall through these financial metrics. And I do want to mention this just real quick before we end our discussion today, because this is an indicator that's as good as your depreciation schedule is going to be, and as we mentioned earlier, there's a lot of reasons why that may or may not be true. But within your financial statements, you will find a number not just for your annual depreciation, which we've looked at, but your accumulated depreciation, and then also for the total value of your plant. And obviously, we don't want you to get too close to 1.0 on this particular number. That would be an indication that the total value of your plan has been depreciated and that you're likely at the end of your useful life of your system.